Bună dimineața. Now I'm going to switch to English. And that was a nice introduction from Gabriel. Appreciate the opportunity to be here this morning. I'm really not going to offer too many answers for today or for tomorrow with the topic we have here. Mainly what I want to do is introduce our company, and we would ultimately like to be a part of the Romanian industry, so maybe we can, while we talk about that, touch a little bit on this topic. Let me start off by just giving you a little bit of background of the company. I'll start with the name, Tenaz. That is a Spanish word for tenacity, tenacitate in Romanian. Symbol is a shark, which our logo is a shark. That's one of the symbols for tenacity. And what I'm going to describe to you this morning is our business model. Basically, it is to acquire and then exploit, hopefully improve producing oil and gas assets. It certainly involves development of the properties. It can involve exploration as well. And I'll try to put it into kind of a historical context for our team and then talk about what we want to do going forward. We're a public company, TNZ, traded on the TSX, Toronto Stock Exchange. And as a result, we have disclaimers in this presentation. This is our advisory on forward-looking statements. Presentation, I think, will be on the Energynomics website. You could find a more detailed version of this on our own Tenaz website. So, background for the company. We formed the company over the past year. It's an ex-Vermilion and Baytex Energy team from Canada and the U.S., as I'll show in a second. We were used to running public companies. There's a lot of disadvantages to being public, for sure. A lot of reporting, a lot of trouble, a lot of disclosure that you have to make. When we sought to form Tenaz and again execute this acquire and exploit model that we'd used previously, we considered private equity as well as public equity. Cost on the private equity was really just too high, so we turned back to the public markets. The way we went about it in this case was to recapitalize an existing Canadian company called Altura. They traded on the TSX Venture Exchange. This is sort of a junior exchange in Canada. Canadian market is a pretty good place to raise capital for further acquisitions. So we knew the Altura team. We proposed to the Altura board a different strategy for the company, one that involved international acquisitions. We lined up some institutional investors, coupled with some money from the management as well, to invest in Altura, put a fair amount of cash on the balance sheet, reconstitute the board, change out the management, and then change the name and begin trading under the symbol TNZ for Tenaz. We subsequently moved the trading off of that junior exchange, the TSX Venture Exchange, onto the main TSX trading vehicle exchange, and currently we trade there. Market cap of around $60 million. We have about $20 million in cash. So I'll start off just very briefly with the team. Really, three companies in Canada and the U.S., Vermilion Energy and Baytex Energy for the past 16 years, 8 years each, TSX and NYSE traded vehicles, and then prior to that, Dominion Energy Canada, which was a part of a big U.S. utility. That company still exists, Dominion Energy, that is just traded on the NYSE. I'm the CEO. Mike Kaluza is our Chief Operating Officer. He ran a 100,000 BOED operation with Vermilion in 10 countries, and our objective is to be 100,000 BOED over about a 5-year period. Brad Bennett is our CFO. He was treasurer at Vermilion and had a number of other financial management positions. The rest of the management team comes primarily from Vermilion, but also augmented with some strong people from outside of that, outside of these companies, and the technical competence in the company, which we feel we have, is very key to what we do. To properly evaluate the companies or assets that we're trying to acquire, and then subsequently, take those assets over and run them according to our business model and improve the results, at least for the purposes of our shareholders. I'll speak very briefly about the board. Very ESG oriented. In our company histories, we had always stressed sustainability, the use of oil and gas infrastructure as part of the energy transition, and we're going to continue to do that, and our board is constituted accordingly. Marty Proctor is our chair. He's very ESG oriented with Green First Forest Products and in his previous oil and gas ventures, including running a big Canadian gas company called Seven Generations. Anna Alderson is our audit chair. That's a very important position. She's an ex-audit partner from KPMG. John Chambers, continuing director who came from Altura, stayed with us at Tenaz. Technical education, but really a capital markets history, having founded First Energy, one of the significant Canadian independent brokerages. Mark Rollins is a European. He was one of the key people at BG during the growth phase, and subsequently was CEO of Ukranafta. And I am the sole non-independent director. Strong board and very ESG oriented. So briefly, I'll cover on this side the model that we want to follow. I can show it from the history with the two previous companies, publicly traded ones, Baytex on the left in blue and Vermilion in orange on the right. The upper half refers to the growth and income results of the company, growth in terms of production, income in terms of paying out cash to the owners. On that upper half, the columns using the left y-axis represent production in thousands of barrels equivalent per day. The line is accumulative dividends in USD in billions on the right y-axis. So pretty good growth, as you can see in the blue bars at Vermilion. We paid out $1.2 billion in dividends during that time. Even stronger growth rate, pretty high actually, compounded growth rate of 11% at Vermilion on the right, and paid out about $2 billion in dividends. So this is what we would seek to do with Tenaz. We're a public company. We work for our shareholders. We're shareholders ourselves. We try to translate that into public market performance in terms of TSR, capital appreciation, and an income stream. Did it work in that previous 16-year history? Baytex on the lower left, 2004 to 2012. There were 47 Canadian intermediates during that time in the public market. We finished first out of 47, beat the index by about 220%. Vermilion on the lower right. Now, this was a tough period in the industry, 2012 to May 2020, right kind of at the depths of COVID. And the industry, believe it or not, for that 8-year period, the 24 intermediate-sized companies represented here had an average TSR during that period of minus 75%, a very difficult period for the industry. We had a negative return, too, during that time, but it was 40% better than the average, so third out of 24. We think the model works to acquire, develop organically as well, and return money to shareholders, first out of 47, and then third out of 24 over a 16-year period, and that's what we'd be seeking to do again. Next slide, I'm not going to cover in detail, but the point behind this is that to run this kind of model, you've got to be pretty efficient in your operations. You've got to be real efficient with your capital. We crushed a lot of capital cost out of the system, a lot of OPEX per unit, a lot of G&A per unit. Comes through reducing absolute costs and actually growing production during that time and spreading fixed costs over a bigger base. That's what allows you to pay a dividend while you're still growing production in the company. Technically, a lot of the way that we did it was through the use of horizontal wells, and not just fracked horizontals. We used unfracked multilateral horizontal wells as well. In fact, during the Baytex era, we were the world leader really in using these unfracked multilateral horizontals. On the right here, we point out that at Baytex we had the longest well in the world in terms of total meterage or footage drilled, 73,000 feet, a little over 22,000 meters in a single well, unfracked, coming out of 22 laterals. In certain reservoirs, it's a real effective technique. And in addition to that, at Baytex and at Vermilion, we used fracked horizontals, but I'll talk about the context in which we tended to use them. Very technically focused company, relates back to that capital markets model. In Tenaz, by virtue of taking over Altura, we have a current development project. It's in Canada, south of Edmonton, Alberta, called Leduc Woodbend. It's an oil project. And here we're drilling horizontal wells. We do use small fracs, multi-stage fracs in these wells. Started out at a mile or 1,600 meters or so. We're now up to 2-mile long wells. That'd be 3,000 plus meters of horizontal lateral, and a lot of frac stages along it. I don't know, up to 100 frac stages, something like that. We are doing this not in a shale. We're not really so much shale experts or shale players. We're not after the ultra-tight rocks. We're after typically sandstones, sometimes tight carbonate reservoirs that are just lower permeability, kind of in the tenths of millidarcies, but not that nanodarcy sort of perm typically in the shales. Some shale experience, but it's really not our forte. So this is an example of that. We call it semi-conventional development because it takes a conventional trap, yes, a low permeability one, but a conventional trap, and uses an unconventional development technique, in this case horizontals with multi-stage fracs. Again, doesn't necessarily have to be fracked depending on the circumstances, and it can be applied in more permeable rocks as well, especially with those unfracked multilaterals, to generate what we think are the best economics possible in the development of the field. This is a good asset. It's a relatively small one, I would say, by our standards. Currently produces about 1,200 barrels a day. Our goal as a company is to build to about the 100,000 BOED level over about a 5-year period. This project can grow. It can reach 4,000 plus, maybe 5,000 barrels a day, we think, over a period of time, drilling at a pretty moderate pace while still generating a lot of free cash flow. At quite high returns. We currently have an oil price of around $85 a barrel for WTI. That's 1-year payout on these wells, over 100% IRR. So it's a good project, kind of small by our long-term standards, but we're going to continue to develop it. So that's kind of where we are today with Tenaz, with the team, the recapitalization, the existing good growth asset that we have, which will be a small piece of what we're ultimately seeking to do. Over the long term, I want to talk to you about our vision and strategy. The model of our company, we're an E&P company, we're a producer. Our model is to acquire assets, typically producing assets, and redevelop those assets. We will take on exploration projects. It's not going to be the primary focus of the company, but we'll take some projects on that are a little bit, further into the higher risk realm. But mainly what we want to do is acquire and exploit existing producing assets. The collection of countries that are highlighted here, both light blue and dark blue, are the ones that the team has worked in previously. The ones that we would consider to be, for us today, investable jurisdictions are the ones in dark blue. And really there's 3 main regions. The box that is shown here, Europe foremost and MENA second, Middle East, North Africa, so that Europe-MENA box is really the main area that we want to focus on, and certainly Romania is part of this. It's a great industry. We've evaluated a number of assets previously. We'd like to be a part of it over the long term. That's the top geography for us. South America would be a secondary geography. The teams work quite a bit there. It's not as big a sandbox as Europe-MENA, but there are still some, we think, good opportunities in there. North America, we consider ourselves to have optionality for Canada. Certainly, we've worked a lot there. Most of us started in the United States, and it's valuable, I think, to have that experience there. It's a super competitive industry. Costs are driven down to the minimums there. There's a lot of good technology that comes out of there, but it's a pretty competitive one, pretty dog-eat-dog. And we don't know if we have a particular advantage in that market today, so we haven't really identified it as a place we would invest. So Europe, MENA first, South America second. Optionality today for Canada is how we see where we would pursue assets. We do think that we can find both conventional assets over time here and some overlooked semi-conventional opportunities. We think there's a little less competition than in North America. We think we can effect more operational improvements in line with our capital markets model and therefore get higher returns. We're going to emphasize, as I talked about earlier, ESG performance to get us acceptance in these jurisdictions and in the local communities as an operator. Ultimately, the strategy that we will follow in running the company is to, when we enter a new area, culturally, we will take on the existing staff. We consider them a very valuable asset. We're going to run the company with a very flat structure. It's going to be very technically focused. Everybody in the company is going to be incentivized with equity in the company to produce those returns for the shareholders. In terms of operating approach, we're going to run with regional business units, maintain typically what we have in place when we acquire, and feather in some North American human resource content in the technical areas and management parts of the company to generate growth inventory out of these assets going forward, have an appropriate growth rate for the asset base. It's all designed to relate back to the capital markets model, where we're going to be putting in place free cash flow assets, or ones that can generate free cash flow, maybe under a different approach, to fund that growth and income capital markets model. We'll use some debt, but relatively low levels, and we will manage the commodity exposure through hedging. So that is really the company, what we intend to do. We see value in these overseas markets. It's an approach that we have applied previously, and we believe we can do again. And everybody in this company, including in the new operations that we take over, is going to be incentivized to deliver for our shareholders. So thank you for your attention, and that is the Tenaz model.
Thank you. Thank you very much, Anthony Marino, for our presentation, and good luck. Good luck in this new endeavor. I am interested a little bit more about your views on Romania opportunities, taking into consideration your approach. If any questions from your part, please just show me your interest, and I will give you the floor. Please tell us a few words about what do you see as more promising in Romania. I suppose not necessarily waiting for a new round of concession, but looking for companies interested in divesting in Romania and maybe acquiring some of their assets, or else, I don't know.
Yeah, well stated right there. That's what we intend to do. We think it's a great industry here. It's got a lot of oil and gas. It's kind of the linchpin, in our view, producer in Central and Eastern Europe. It's very diverse types of production all over the country. Probably we would stick to the onshore industry, and we think that what I outlined earlier in terms of company approach, the way we've done it historically and the way we would intend to do it in the future, would apply exactly here. Every jurisdiction has its own set of difficulties. Every jurisdiction has its own administrative challenges, its own land access challenges. That they exist in Canada, United States, every country in Europe, in the Middle East, South America. Everywhere that we might go, those challenges exist. Romania has its own set. It's, I would say, actually a good jurisdiction in comparison to the vast majority to be in. And, we think that if we go through careful evaluation of the assets that are on offer or that we could identify as potentially dealable, we do that careful evaluation, carefully structure a potential deal, try to meet the needs of sellers. We think that this is a place that we could get assets, and we'd want to build it over time. We know it takes a patient approach. In our previous company, we looked quite a bit at Romania without having made a deal. We're, I think, going to be a little more focused on it in the new one, and we think we can be a good participant in this industry over time.
Another question from my side: is there any? What are the potential circumstances that might put you on hold in Romania and in Europe in general? Talking about the price of oil, I saw some calculation there for different IRS and, depending on the price of oil, and also the different taxation. We read the other night Ursula von der Leyen saying oil and gas companies are at the moment where they are supposed to support consumers. And maybe this is the way to prepare for a Europe-wide new tax for the oil and gas industry for the producers. What do you think that would be? What is the great risk to put on hold your projects of this kind?
Yeah, I mean, it's a good question there. I mean, you know, the first part of it, just the high commodity prices, this huge run-up, you know, it does affect a business model like ours for sure. You know, we kind of came out of the previous company right at the trough of the pandemic. We thought it would be a good time to get organized, to you know, invest at when commodity prices were low, and we found that commodity market changed very quickly. While we were putting our vehicle in place, you know, we started to have this big run-up in prices, and once we did the recapitalization last August through October, almost exactly 1 year ago, we were kind of, well, prices had already begun to recover off the, you know, crazy lows and negative prices that you had at the trough of the pandemic. But then they began this big run-up, then the war started. So in that kind of environment, for sure, it's tough to run an acquire and exploit model, because the sellers have a certain expectation and the buyers don't kind of have confidence usually in that kind of price environment continuing. So you get this gulf, you know, this chasm between and the bid-ask spread. There are ways of bridging that, and like we've seen it so many times historically, you just got to get used to that run-up in prices and those crashes afterwards and deal with this, you know, crazy volatile industry that we're in. I think that since we've been through it multiple cycles before, although this is a pretty wild one, as low as we went and then as high as it has gone, especially like now in European gas prices. I remember actually in May of 20, we were looking at some $1 and $3 day-ahead bids, or 1 to 3 euro per megawatt hour day-ahead bids for gas, and you know, you have 100 times that today, so that's a pretty big cycle. But I believe we can deal with it in either product. You know, the question of some kind of windfall profits tax, I guess, kind of unknowable. They've been applied elsewhere in the industry over 50 years. You know, way back to the original energy crisis in the 70s, even in the United States, they weren't very effective. They do tend to restrict production. What everybody needs today and what Europe needs today is supply. And it will get supply over time. There's no question about it. It needs indigenous supply. I think there's a lot more potential for that than you know, we've been able to take advantage of today so far. Europe will get supply from the Middle East, from the Near East, from LNG, from Americas as well. So over time, you know, those prices are going to come down. My opinion is the only way really to deal with it is through market mechanisms that control how much of it is used and encourage the supply to be brought forth over time. You know, the question of windfall profits tax, something like that at a EU level, I don't know. I don't know if it will occur. To me, it's kind of something that has been tried and was not effective. So, you know, hopefully economic reality will prevail on it. Yeah. But we'll just have to see. And if it occurs, it's something we'll deal with. We'll deal with then.
Thank you. Well, another question from me, maybe the last one, maybe. You are running a company which is very much focused in oil and gas, with a very rich history and background in oil and gas. What does it mean, ESG and energy transition, from such a company?
Yeah. Okay. Yeah. For us, historically, what we wanted to do and what we did do was projects that actually were real economic projects that took existing oil and gas infrastructure and used it for energy transition projects. For example, the use of heat from our oil and gas operation, essentially a geothermal set of applications where you bring up all this hot water, we use it, we re-inject it for water flooding, but before re-injecting, we used it to heat greenhouses, we used it to heat apartments via very simple equipment, just heat exchangers, and there was a significant benefit in terms of carbon that was not burned and put into the atmosphere because it removed the need for alternative heating. It jump-started new industries in terms of ag, very sustainable industries for the long term. This is the type of thing that we specialized in previously, and it got good recognition in the investment community. It got good recognition in the countries, the jurisdictions we were in, and the local communities. So it has real benefits for the overall carbon profile, has real benefits in terms of demonstrating how oil and gas can contribute to these renewable and sustainable industries, and it has benefits to the shareholders. That's the type of thing we want to do going forward. We do believe, that oil and gas are in fact transition fuels in and of themselves. For sure, we want to get to a lower carbon future. We know we will. Best way is kind of through market mechanisms and also the proactive ventures by these oil and gas companies like we have done, and that's what we think of as ESG and sustainability. I mean, in a carbon sense anyway. Goes well beyond that in the social realms, and of course you want a very safe operation, which we've always stressed. That's the most profitable way to do the business as well, and that's what we intend to do in Tenaz as well.